So just to, I've had a key concept of the market, and I know exactly how the forex exchange market works because of my time and effort that I've been putting into this industry for a while now. Okay, and before I start to teach you what I have to teach you this morning, I would like all those people that are sleeping again to stand up and tell the devil to leave them alone. I myself have told the devil to leave me alone because I want to talk to you this morning. I want to have the energy to be able to talk with you this morning. And I want you to tell God to give you the strength to be able to listen to me throughout this program this morning. It is not given to everybody to be able to get up at this time. So, my friends, I want to congratulate you. And as I've said, I want everybody to be very focused. Have your pen and your paper to jot down important information. And I bet you by the end of this 2 days program, you will be you'll see a great shift in your trading style. Also, the video of this program will not be available on Telegram for anybody. And so, my friends, I'll just explain from this chart a little bit so that you can understand what smart money concepts can really bring to you. I'll just take, for example, my chart that I have on the screen, okay? Let me just explain to you based on this chart a little bit of what a smart, the way you could look at this chart. Now, on our screen, from here behind, we had, if you can look very well, you guys are going to realize that my analysis started right far behind here, whereby I have a series of higher heights, higher lows, and I consider a new higher height to be created when a former one is being broken. And a higher height, all my structures here are called swing structures. That means it actually, I will take the lowest point in the break and the highest point in the break. So when I look at the lowest point that caused the break of this other high is this first one. And this is the highest point that was created in that after this break. And when the market shifts down for a retracement, this is the lowest point. It creates a new higher height all over. As long as new higher heights are being created, that means the market is valid until when we are going to have a higher height, which is being broken. So until when we are going to have a higher height, like, okay, a higher height being broken, and at the same time, a low being taken off, like what you see here. This low got took off and we already boss break of structure. So it has been a change of bullish character, not a bearish character. So definitely means here that this market is going to face a retracement. If you repeat this process again on this retracement, you are going to be finding structures in the market like lower lows, lower height, and until you get to a point whereby you will see one of the structures being broken again, like boss. I am not teaching this for those who understand this already. I just want to explain to you and get to where I want to take your mind to. So this is not teaching you market structure, because when it comes to teaching you market structure, there'll be a way I'll take to teach you that everybody will understand. But what I'm trying to do here is just bring your mind to this class so that you can understand the depth of this lecture. And when you have this break of structure here, boss, because you can realize that there is a change in the bearish characteristic. That means the market have changed from being a selling market to a buying market, with a confirmation based on a structural confirmation. And now we can start to demarcate. As we demarcate and go, we realize that higher heights and higher lows are being created and the market continues to go up. So recently, my friends, we found ourselves somewhere around the structure here. And this is where we have been trading for the past week. And if you look here very well, you can see clearly that we have had a higher low here and a higher height right up here, which has not been broken. So at the moment, we can define this market as an uptrend because a higher height is still to be broken though, but a higher low has not been broken. So all this here is not a higher low because this higher height was not broken. It was just a wick out and the candle did not settle above this on the 4 hours chart. So this low here is a weak low and this weak low can easily be taken off and I'll explain more to you. So at this point, when you look at this, for example, we are waiting for two things. The first thing that we are waiting at is we may want to see this higher high being broken the right way. So automatically it will be that this is our new higher low here. Now, this is just to maintain the concepts and the idea of a market that is going up or a market that is going down. But now when you understand that, okay, a chart is going up or a chart is going down, investigation will be done with the impulsive movement and the corrective movement. The impulsive movement are the movement that goes in the direction of the trend, and the corrective movement is what goes in the opposite direction. And so let's just say, for example, here, why I choose this point as my point of interest. When you look at this movement that led to the break of a higher height and the creation of a new higher height, if I want to calculate or I want to analyze a retracement ability, I will be doing my retracement ability based on the performance of this trend, which is my impulsive trend. Okay. So I, as a smart trader, I'll investigate the different places where we had bank or institutional execution in this point for me to always like think, okay, I can come back here to trade. Let me explain to you very attentively for you to understand. The concept of smart money is being based on two things. One, finding where banks executed their orders. And two, finding where people have placed their orders. Now, the first one is where banks enter the market or where big institutions enter the market. And most of the time, because in the forex exchange market, when the big institutions enter the market, they have this ability of not filling all of their orders when they execute. So a bank can execute a market here on a sell, for example. And when he executes this market, not all of his orders are being filled. That means the bank will have a 10 billion worth of order here, and just about 6 billion is being filled. And the bank needs to fill all of these orders to be able to serve its clients. So the concept is simply that they may have to come back again to this point to fill the remaining orders before the market goes. So if you are able to identify a structure where an institution enter the market in your chart, then definitely you can wait for price to come back to that point again for you to buy. And this is the only ways that you can use to have perfect point of executions. Are you guys getting me? These are some of the only ways that you can use to have a perfect sense of execution. Another second point when we talk about smart money is like the first part is identifying where institutions enter the market. And because when the institutions enter the market, not all of their orders are being filled. They have the ability to come back to that point again to fill the remaining orders. That is one thing. I want you guys, I'm just trying to open your mind to this class for you to understand that all what we are going to be doing will be focused on finding two things: where an institution enter the market and also where people are planning to enter the market or where people have entered the market, which is because liquidity. Now, So one of the greatest things a smart money trader will be doing is to find the structures where the institutions have entered the market. And there are different ways of identifying it, which we are going to come to it when we'll be looking at methodology of bank trade execution. So my friends, when you look at this wave, this impulsive movement that led to the break of this other higher high here, because this is higher high one, the break and create higher high two. You get it? So if I'm to look at this, the retracement of this movement, I'll begin to investigate where on this chart did an institution enter the market. And one of the techniques we could use is the rally base rally. So when the market rallies, the base is a rest. And for that market, that base is a point where the market is exhausted. And for that market to be able to lift from there, and especially in the direction of the trend, that means that we need a huge amount of order. And most of the time, this huge amount of order will be provided by what? The banks or bigger institution trading forex. So definitely a good execution from a base can be determined using what? The type of candle size that leave that area can tell us if it was a big institution. The bigger, the longer the candlestick size, it simply means the bigger the volume. And when the volume is too big, it definitely means that that volume was injected in the forex exchange market by who? By an institution. Listen to me attentively. So that's why when I was doing my analysis here, I knew definitely where, like from, I don't want to go back to the old things. I just want to go to the most recent place where we have been trading. So you guys are going to realize, if I put this on the 1 hour, probably you guys were going to see from here that this market rally from this bottom. That means a rally means was going up. It was going up very nicely. Okay. And when it comes to this point, what do you realize? Market had some period of consolidation like a base. And after that consolidation, market rapidly left this point with a lot of imbalance, with a lot of energy that day. And when you go on the 4 hours chart, you can see it very well. A very fat 4 hours candle that left the zone with a lot of momentum. So it simply means that there were some banks that after this resting phase, they enter a huge amount of money and not eventually not all of their others were failed during that trade execution. So they had the potential to come back to this point. So when I'm looking at, okay, where are the possible level of retracement for this particular movement that I've demarcated here? I now begin to have different point of interest. This POI means point of interest, a point that interests me in the market, a point that draws my attention. So it draws my attention to that structure for me to believe or to know exactly that market can come there. This is what now we are talking about smart money. Now, another trader will just go ahead and be drawing support and resistance lines. So, but me, once I've drawn my point of interest, I can go ahead and fill down my point of interest to have a specific zone. So on this chart, okay, I were able to switch down to the 15-minute chart, for example, in that zone, and I was able to grab a more accurate zone on that 4 hours. And the most accurate zone or the most accurate point here in this consolidation here, they are the liquidity wicks, these rapid rejection wicks down here. So that is whereby banks were pumping in huge orders and you were seeing a rapid rejection. You could still see that point of bank execution, maybe through an order block or maybe through a lifting of a very good candle from there. So, like for example, anyway, we'll get to other examples which we're going to see. So I was able to pin down this to this point. So when the market was actually buying and going, I have one thing in my mind. I know that this market eventually will have to come down I'm going to have a good retracement to this zone. There was one guy seated at my place when he saw this analysis. And when it came to this structure, the guy was like, Prof, it's like you're a rich man. But I explained to him everything. That I want to bring few people's mind to the fact that a good knowledge on technical analytics and a smarter way of trading can make a lot of profit. So you guys can see how the market came exactly to that point, reacted and started to go. Listen to me attentively. And before the market could come to this point, market has come and made as if you want to go up from here. Because if there is not enough liquidity to bring down this market to this structure, the institutions, they need to do everything humanly possible to push, to confuse, to like those who are weakly minded, like they don't know, like you have analyzed the market like this, you have seen a clear setup, but you are waiting for price to come back here. If you guys check very well, you guys will see a setup whereby I think last week when I did analysis and brought an arrow here, the market is going to come here. But unfortunately, it did not come to that point. So you that is actually right, and you knew that market had to come to this point, and the market doesn't come there as you thought, you forget about this analysis because you have a weak mind and you don't trust what you are doing. And maybe definitely it's because you don't spend more time on your chart to see these things happening. You guys can see the way they did. They struggle to take price up, but they can never take this price up because they have some orders here that they have to fill them. They have orders here where they have to fill them. And at the end of the day, you guys can realize that this market again had a very fast move from here, from this top. And the market began dropping and until you got here. And you can see very well, anywhere the institutions execute a trade like, you'll be able to identify it. Let me just take to the 15-minute. And you see that for this market to finally come to the downside here, you can see for yourself that when the market started to drop, we came here and we had a base. Like here you saw a buy to sell candle and a lot of manipulation. When I was doing my investigation, I saw that the institutions entered the market here. So I was able to demarcate against this structure. Because in anything that will happen in the market, we are going to be having pullbacks. So for this market now to leave from this structure to my point of interest down here, it will follow also a pattern. So when I realized that there was an institutional entry here, I was able to demarcate again that, okay, the banks have to take this market down to my point of interest. We need some trade from big institutions. And this is where they did enter the market for this wave. And now, when I saw this impulsive and this retracement, I definitely know that this retracement is retracing back to where? To where these institutions enter the market. And this same trade like this, I took this exact same trade and I led them down here. Now, listen to me, my friends. Let me show you something. Now that the market approaches the point of interest that everybody is waiting at, they will do everything humanly possible for you to buy this market before time. That means you will buy the market before it gets to the right point. And when you buy this market before time, I told you people in the forex exchange market, you can either buy or sell in two ways. One of the ways to buy is to place a buy order. And one of the ways to buy again is to close a sell order. Once you close a sell order, you have bought. And once you close a buy order in forex, you have sold. So my dear friends, listen to me very attentively. They are coming to this structure here. But before they get to the structure, they stop. Because they know that some of you are so impatient. And when they come to this structure here, they begin to bring out candles like these green candles that you are seeing here with some degree of consistency that you may think that this market can start buying from here. And they will spend some time, like an hour. Because if you want to count these candles here, you see 15 minutes, 15 minutes, 15 minutes, 15 minutes. This is only 1 hour. 50 minutes, 50 minutes, 50 minutes, 50 minutes, this is 2 hours. So you have been waiting anxiously to trade at that point. They come there, they take 2 hours of your time just to make sure that you enter the market before time. So they need to create the liquidity that they need to take price away from there. So the bank again had to do some work here. That means when you only know these things when you study your chart. And when they did the work here, they had two objectives: make some people to buy before time. So when these people bought before time, what did they do? You can see that they brought a very thick red candle out of that zone. It definitely means that after that resting period, the bank traded there. And the bank that traded there was having the main objective to do what? To push on people now to see the momentum from that zone, to start thinking that the market is going to sell. And for those who saw this structure and bought before time, they will be scared to lose. And some of their stop loss will be hit. And definitely they will be doing what? Their buy position will be closed. And when they close the buy position, it means you have sold. It definitely means that what? You have sold the market at a lower price, and you have sold the market at a price which is very cheap. And you have sold the market where they had their buy orders to be filled. So definitely you have provided the liquidity necessary to drive price up. Full stop. Now, those who bought have closed their orders, and now they have sold. Full stop, because they bought and they have closed the order. It now clearly means that they have sold. And now there are some people that will sell automatically by seeing this great momentum from this area. They will still place sell. And now the bank now, because this candle, this stick here was a sell to buy candle, automatically you see price now began to buy from our point of interest. Market now begin to go up. As market was going up yesterday, that was after yesterday, I called my friend again. He's called June. He's my neighbor. I said, come, my brother, I want to explain here something to you. You see what happened here? These institutions, they did a manipulation here. So they did what we call a sell to buy. So the institutions, they sold the market in return to buy. But now listen attentively. When they did the sell, they have done two types of trade. They have sold and they have buy. So it means that some of the sell position that they have is in a loss, but their buy position is in profit. So they have two trades running. One is in profit, which is a buy trade, and the other one is in loss, which is a sell trade. These people can never in the history of mankind take this market to the upside without closing those sales orders. And I told him, my brother, look what will happen. Price is going to come back exactly to where these orders were executed, to the initial execution point of these orders, for this institution to close their sell order on a neutrality and then them buy the market again massively. So that's why you saw these people now, they then took price back to where the manipulation occurred. It's not even manipulation, it's just thinking smart, where the liquidity creation time occur. So they then took back the market to that point and now closed their sell orders and definitely now rapidly took price up from that structure. Now, my friends, you can see from here is a liquidity width that had a confluence with the trend line. This market now rapidly moves up. We have a retracement, and when this retracement occurs, price again rapidly left from that structure. So after the retracement, a huge positional buy again came to the market. And this is a structure where these liquidity wicks are, where the institution bought again. And when they buy again from here, probably not all of their orders are being filled. And that's why at the end of the day, this candlestick, this market came here yesterday, filled the remaining buy order here, and then went up again. So my friends, if you are able to identify a point where a big institution enter a trade, you just need to wait for price to come back to that. So my friends, and you can see again, when market went back to this point of interest, where it was firstly mitigated here. This is the first mitigation, price touching that point. Okay, price have come back to that structure because it's showing clearly that there was an important action ongoing here. But now, my dear friends, you can see how far price have been able to struggle to go above this structure. He has wicked it 1, 2, 2 mitigation, 3 mitigation, 4 mitigation, 5 time mitigation. So it means that even if there were some sell orders left on field here, those orders have been filled. And we have two options. If we want to know the direction of this market, we will need to look at this market at a broader perspective. So definitely, market can break above here to create a new higher height, or market can come down. But now, my point of interest was to draw your attention to this class and to make known the purpose of this lecture to you. My friends, Forex is not what you think. I want to tell you the truth. Forex is not a scam. Forex that you see is not, there is nothing like manipulation. There is just a process of a market having people willing to buy and people willing to sell. And in that market, for me to buy and make a profit, you should have sold and make a loss. Are you guys getting me? It's logical. For me to buy and make a profit, you should have sold and make a loss. If me, I go to Douala or I go to Yaoundé, buy something for 10,000 in Yaoundé. That's it. 10,000 is the price of that thing. I bring to Douala and sell to you as 15,000 francs. It definitely means that for me to make this 5,000 francs extra, you have lost 5,000 because the real price of this object is 10,000. Are you getting me? Now, for me to buy this item and gain would have just been in only the process whereby this man bought this item at 10,000, brought and sold to me at 5,000. Now, the man have sold this item and lost 5,000, and I've bought the item, I've gained because the actual price of that item was 10,000. I bought for 5,000. So, my friends, you come to realize that the forex exchange market is made up of two groups of people, those selling the market and those buying the market. And what is always going to happen is that we need to follow the action of those who have a greater amount of money to move the market. And the action of these people can be spotted. It's not magic. Nobody should ever fool you, and nobody should intimidate you that there is a forex secret or there is an extreme way they use to trade forex. It could be a strategy. But I want to make you understand that if you follow me from the beginning to the end, you'll be able to identify that on my chart, this is where a bigger institution enter the market. And we can spot them out using what? The type of candlesticks. And that's why candlestick is very essential to any forex trader. I will prove to you again and again, again and again. You can see this huge movement that occur here like that. You can see that it is not this type of movement that is struggling to move. It is a rapid movement. I mean, an extremely rapid movement. And this type of movement is only injected here by a bigger institution. That means by somebody that have a big amount of money to quickly move the market. And this point here where the person enter the market, it means there's an initial point where this person enter the market. And this initial point could be an order block, maybe the last buy candle before the sell. So if you mark it out clearly, you will see for yourself that this is a point here. It simply means that this is where this institution, they put their sell orders. And when price come back to such zones, there must be reaction. You see, price came back, touched it. There was a rapid rejection because this is maybe probably where some of these sell orders were finally filled. So the institution have the habit of buying and selling. But now the problem that they have is that they don't have enough money all the time to fill their orders. And simply will have to come back to that point where they enter the market to fill the remaining orders. That is the concept. The concept is when they eat, they are not always satisfied. So they are going to come back the next day to see if there is still much available food there so that they can fill their stomach. And so, me and you, because your account size is $100, is $1,000 only. Your account size is small like that. You cannot move to the forex exchange market. We are going to be waiting to enter the market where we think that these institutions have executed or when they are executing. And the only way to succeed in forex is to know when these people are trading, full stop. And we have derived methodology to be able to identify their footprint. And we have also derived methodology for you to think out of the box. Why are you here at 2 a.m.? You are here at 2 a.m. because you want to give in your mind to something that will help you. This program will take approximately two days or 3 days for us to be over. But the first part of this lecture is to bring your mind to the class and first of all, make you understand that it's not mystical. And secondly, I want to make you understand that what Mr. A can do, Mr. B can do. I want to make you understand today that your opportunities can come from this forex. If you have watched my status, I will take 5 minutes to tell you a story. If you watched my status some few days back, you guys are going to realize that some 2 guys came to my office to visit me. These 2 guys, one is Camillus and one is Dominic. Camillus has an opportunity to study forex in Bellforex through a generosity that I did. I then said, one time I said, if you share Bellforex, if you share contents about Bellforex, we are going to select the highest person that shared and we'll give them free trainings. That was Camillus. He had a free training to learn forex in Bellforex. And when he was learning forex with us, his brother Dominic was in the house and he then pleaded with me, can I allow my brother to be attending the classes? I said yes. The brother Dominic began attending my classes. All of them free of charge. Nobody paid anything to me. Same as in the current batch, we have many people in this community that are owing fee and some that are learning for free. And I always take this opportunity to tell you that if you are owing fee, I don't remind you because I don't write your name in the book. Make sure that you come and pay. If you are owing Bellforex fee, come back after this class today and pay your fee. I'm telling you the truth. And God will open doors for you. Now, Dominic began trading Forex. And as normal, it's not easy for everybody. He began struggling to trade, and until he knew how to trade well. Now, he then trained one student in Nigeria, not knowing that this person he was training was connected to a multi-billion-dollar pastor in Nigeria. He began training this person. And one day, the guy in Nigeria lost some amount of money in his account that the pastor gave for him to trade. And this, my student, Dominic, then took this account and recovered the profit, make some profit out of it. And that's how the Nigerian guy went to the pastor and said, this person did this, is from Cameroon and is very good. The pastor now gave him also an account trying to test him. When they tested the guy, they realized that this guy was good. And that's how a phone call last year, the Nigerian man, the pastor made a call and was able to move this guy, Dominic, from Cameroon to Nigeria. When you move the guy from Cameroon to Nigeria, when the guy got to Nigeria, the man funded him a live account of about $100,000. Real money, not demo. Not my Forex fund. Real money. Me on Xnext. Real $100,000. This guy traded this money and made about 75% within a period of time. And the pastor doubled this money to $200,000. Gave him an apartment for 2 years. put him on a base salary, and began sharing the profit that he's making in that his life account with him every month. This guy came back in December to get married and decided to come to my office to tell me the wonder work Forex has done to him. And this guy has been connected to somebody that have more than $1 million in his Forex account. And because of the good skills that he learned, he has been able to propel him from a glass worker, because he works on glass work, to a trader in Nigeria, traded with high esteem. I want to tell you, my friends, if you're able to listen to me very attentively, Forex will open doors for you. Forex have opened many doors for me. And that's why I have the courage to teach you for free. Such classes, they have to charge you. I don't need to charge you for anything to this. There's no need charging you, because I know that it's a seed that I'm sowing to some great people. The 90 people available in this class, if you listen to me attentively in this program till the end, I definitely will have sowed something in you that will go to something greater. I believe that so much. And that's why I always say that if you are owing fee in Bellforex, pay that fee. I don't have your name written somewhere that you are owing me fee. I don't even know you owing me fee. But I'm trying to tell you that if you are owing fee, I don't know you, come and pay. I don't have the time to write your name that you are owing me. I don't have that time. So my friends, let's deep into smart money concept. And before we begin, I would like us to start with some basic definitions. Okay? We are going to take this thing small. There is no need to be in a haste. Okay? I want you to relax. Ephraim, I want you to relax. Are Eno, relax. Babila, relax. Basil, relax. Cecile, you have to relax. Christian, feel comfortable. Dion, relax your mind. All those that are sleeping, get up. Get up and you get strong. Okay, let's go. Now, smart money concept is somehow something that many people hear listed on the internet. And I would like to start this with some basic definitions that you will have to know. And this training will start with the basic knowledge possible, organized in a way that you'll be understanding few things step by step to where we are going to get to a massive conclusion. Now, the first thing most of you are going to realize is some few abbreviations and some templates that I have on my chart. Starting with the most basic definitions like H, which means higher height. We have HL, which means higher low. You may not worry to copy this, as I'm going to send you a screenshot of these particular definitions. Okay? But for now, I want you to pay attention and focus your energy on knowing some of these things. Because when we are going to proceed to a level, you may find yourself lost when we are pronouncing some of these things and you don't know about them. So I want you to have your mind focused in what we are doing so that you will not be lost when we are talking about these things. So it is important that when I say a word or when I say a terminology, you keep it. This class is a very long class. It's going to end maybe by 5 o'clock in the morning. So we have what we call lower low. You are going to understand, just know the meanings, okay? When you see me put FIB, it means Fibonacci. When you see TF, it means time frame, okay? When you see MN, it means monthly. When you see W, it means weekly. When you see D, it means daily. When you see H4, it means 4 hours. When you see H1, it means 1 hour. If you see M15, it means 15 minutes. If you see M1, it means 1 minute. If you see somebody write something like MS, it means market structure. MS means market structure. When you see BOS, it means what? Break of structure. BOS, break of structure. When you see somebody have MOM, MOM, it means momentum. So if I want to explain, I'll just say, if I write this on my chart, it means momentum. I want that your chart should be filled with such terminologies. Don't need to write long words, okay? And the community will understand because the community have this analytic standard. When you see something higher time, HF like HTF, it means higher time frame. Now, when you see LTF, it means lower time frame. RSP means real structure point. CPB means complex pullback. You are going to see complex pullback. M can also still mean momentum. Arrow means risk reward. TGT means target. SL means stop loss. BE means break even. PA means price action. LIQ means liquidity. EQH means equal height. EQL means equal lows. SMC means smart money concept. DD means drawdown. BE can also be bearish. BU is bullish. HNS means head and shoulder pattern. Now, IT means institutional traders. IT means institutional traders. CO means composite operators. You will learn about composite operators. Don't worry. WHB means weak-handed buyers. You will learn about them. WHS means weak-handed sellers. DP or POI means decision point or point of interest, where I am interested in taking a trade. Somebody said that he or she cannot see my screen. If you can see my screen, type 1 in the comment section, please. If you can see my screen, friends, type 1 in the comment section. So they can see my screen. So Richard, maybe you have touched you have manipulated your stuff a little bit and you are confused. Now, listen very well. SHT means top hunt candle. OB means order block. OBIM means order block with imbalance. Listen, order block with imbalance is different from order block, normal order block. So some of you have been asking me on my chat, what is the meaning of this OBIM? It means order block with imbalance. OB means lower time frame order block within a higher time frame order block. When you are doing refinement of order block, you have an order block inside another order block. WKF means week off. You guys are going to learn about week off strategies and all whatnot. So PS means preliminary support. PSY means preliminary supply. SC is selling climax. AR means automatic rally. ST means secondary test. As SPR means spring. Test, you can say about test, the retest, all those stuffs. SOS means sign of strength. SOW means sign of weakness. LPS means last point of support supply. LPSY means last point of support, or last point of supply. BU means back up. Jack means jump across the creek. In fact, these terminologies that we have mentioned is not to cram, and not all of them will be used initially on your chart because just some of the few ones that you are going to use. But when it comes to smart money concept, you need to familiarize yourself with all of these things so that you don't get stupid on social media. When some trader posts with this terminology, you then go on and be asking them that, what is the meaning of EQL? They will just look at you and shake their head. So my friends, it start by first of all understanding some terminologies. So that's where the beginning of the class starts, understanding some terminology. And if this terminology are understood, and you can even print a copy of it, put on your trading decks, time to time you look at them and see what they are, you'll be able to master this thing within a month. You are not a machine, please. Some of you think that as we have just said this thing, after this class, you remember them. Don't try that thing. Don't make that mistake. You are not a machine, so you may not remember up to 10 of this thing. So, but the simple truth is that you should be practical. Keep it and be looking at it time over time. And when we are going to be mentioning the terminology as we go, you're going to you refresh your brain, and that's how it's going to stick in your brain. Now, so this training will be part, and each part is linked to another. So the first part, the second part will be linked to the first part. Like everything that we are going to be saying part by part will be linking to another thing that will give you a perfect understanding by the end of the day. Okay. So retail trading, because we are talking about smart money concepts, smart money trading, they say it's institutional way of trading, the way the institution trades. Now, what is retail trading? This is how 95% of traders actually trade. Retail trading is how most people trade. It's the way most people in the forex exchange market think. And that's why most people lose money. Because of what? A retail trading methodology, which maybe they don't understand in depth. So when they talk about retail trading, it is mostly a common way of trading, which people don't pay attention into details. And they don't pay attention into their demand and supplies very well. They don't pay attention into confirmations. They don't pay attention into uh, order flow or volume and other stuffs. So it's just a common way of trading Forex. Now, in Forex trading, my friends, you are going to hear about a trend. A trend is generally what? A direction which the market moves. So if I talk to you about uptrend, then an uptrend is just a direction where the market moves. So right here, my friends, I could look at this market because this market left from this bottom to this top. And I will say that this is an uptrend. That is the directional move. That is what is called a trend. I can say that, okay, this market move from this top to this bottom. This is a downtrend. Trends can be categorized based on a different time frame. And within a trend, there is another trend. So if I put this thing on a daily time frame, you may generally see an uptrend. But in this uptrend, they are downtrend if we switch to smaller time frame. So when we go to the daily time frame, all you can see is a huge portion of this market going up. And again, when you look at it, you can see this portion of the market was going down. That is a trend. So based on the time frame that you use, a trend can have other trends. A trend can have other opposite trends. It means that in this uptrend that you see clearly on the daily time frame, if I go on the 4 hours time frame, I'm still going to see uptrends and I can still see downtrends. So like this period where the market was moving here was a period of upward movement and uptrend. An uptrend which is made up of impulses and corrections. Impulses, correction. Impulses, correction. Now, within that same 4 hours, we have what? A downtrend. Even though the overall trend on the daily time frame is an uptrend, we also have a downtrend in that trend. That we have period of also impulses retracement, impulses retracement, impulses retracement, impulses retracement, impulses retracement, impulses retracement. That's all over. Now, within now the 4 hours time frame, I can look at this market here as an uptrend. Listen to me. But if I switch this time frame to the 1 hour time frame, you will see that we have uptrends in the 1 hours and we also have downtrends in it. So the smaller we go, we keep breaking down something to smaller things, to smaller things, to smaller things that have all the exemplariness of the bigger thing. So when they say Cameroon is Africa in miniature, it means in Cameroon, you nearly have everything that is in Africa. So in a smaller trend, we have what also is in a bigger trend. Are you understanding me? So it is very important for you to understand the concepts of trend in Forex. And now in an uptrend, you have what we call, it forms higher heights and higher lows. Market is always said to be bullish. So note, an uptrend fails when price form a new structural low. So wait for a new structural high, lower high to confirm trend change. First of all, anything that you read line to line, everything we are reading line to line must be treated with caution. Now, they are saying that in an uptrend, as I read to you, I'm saying that in an uptrend, my friends, we are going to have uptrends in something like this, the market moving like this. And when this market is moving, it is forming something. It is forming something that is called what? So they are forming this structure we call a higher height, and this one will be called a higher low. So this is what we are telling you, that in an uptrend, this is what gets formed. New higher height. For this uptrend to continue being formed, we need to continue seeing new higher height being created. And we're always going to see higher lows created as well. Now, when this other structure gets formed, this is what I'm trying to explain to you. Now, if the only condition to stop this market from being an uptrend is that I should have a break of this other structure here. So when this structure is broken, this is what you see in an uptrend. Higher lows, higher low because it's a lower point, because when you take at this market here, this point is higher. Point A is higher as compared to point B, first of all. So this point A is a height, and point A prime is higher than point A. That's why we say a higher of the height. And point A prime plus here is higher than point A prime. And that's why we'll term it again a higher height. Now, point B prime is higher than point B. That's why we're going to say a higher low. It is low as compared to A. It's low as compared to A. And point B prime plus is higher than point B prime. And that's why we are going to call this a higher low. Listen attentively. As the lows are not broken, the market is still in an uptrend. When the lows are broken, it's a sign that the market is going to change its direction. And what did they say? They said that what? Read in my notes. Clearly stated that what? When wait for a new lower height to confirm a trend change. It means when a trend is broken like this, I'm going to wait for a structure like this, lower height. So I will explain to you what a lower height is. So I'm going to wait for such retracement, which will form what we call a lower height. Now, in a downtrend, market is going to be forming lower height and lower lows. It explained us. It means that let's assume this is A and this is A prime and this is A prime plus. Now, A, these are B, this is B prime, and this is B prime plus. As compared to A, B is low down here as compared to A. Now, talking about B, B prime is at a lower point as compared to B, and B prime plus is at a lower point as compared to B prime. So that's why it will be termed lower low, lower low, and lower low. Now, A prime is lower than A, even though A is high in respect to B. So A prime is a high, but it's a lower height because there is another height which is above it. And A prime plus will be a lower height compared to A prime. That's why you're going to be hearing lower height, lower height, lower height, going down, lower height. That's where the definition comes from. Now, if these structures, these are the lower heights, these are the lower lows, these are the lower lows, as long as the lower lows get broken, the market continue in a downtrend. But what happens if the market goes up and break a lower height? It means that the downtrend is about getting over. So an uptrend needs to be formed. So we are going to wait for what? A pullback. And in an uptrend, such pullback, we'll be calling this zone what? A higher low now. So we are going to wait for the formation of a higher low. So for us to execute our trade, possibly here with confirmation. So when a lower height, when a structure is being broken, we don't just skip it and start buying the market. We are going to wait for this retracement that will form a structure of a change in trend. It means that if the trend was the downtrend, when the trend changes, we'll now begin to have the characteristic of an uptrend, which are higher heights and higher lows, higher heights and higher lows. And same in an uptrend, when it changes, we'll begin to have the characteristic of a downtrend, which are lower lows, lower height, lower lows, lower height, lower lows, lower height. Full stop. I believe that this is clearly understood by my students. Now, my friends, listen to me very attentively. When it comes to market structure, listen, that means I am treating now market structure. This is how we define this thing small. I will now be treating now market structure with you. When it comes to market structure, there are swing structures. See, watch clearly what I'm about to do here. Let's assume we are in an uptrend, okay? In this uptrend, my dear friends, that's what I'm working on it now. Somebody's asking me the condition of drawing a perfect trend or a market structure. That is what I'm working at. That's why I said Everything is a step by step. So let's finish with this now, market structure. Now, when I'm drawing a market structure, irrespective of the time frame, I don't care the time frame. The simple truth that if it's an uptrend, I'm going to have period of what? Higher height, higher lows, higher height, higher lows, higher height, higher lows. Now, listen to me attentively. Higher height, higher lows. Now, my friends, this direction of the trend is up, and all of these ones that are in the direction of the trend will be called impulsive movement. Impulse, impulse, and the one that in the opposite direction are called corrections. Okay? Now, in each of the impulse and correction, there are other trends inside. Listen. So it means that in this correction here like that, there is also a trend. If I move to a smaller time frame, I'm going to see a downtrend in a manner forming lower lows, lower height, lower lows, lower height, lower lows, lower height. And in this impulsive move, I also see an uptrend in a smaller time frame, forming higher height, higher lows, higher height, higher lows, higher height, higher lows, higher height, higher lows. So in a trend, there is also another subtrend. First and foremost, look into this. We are in the daily time frame. So if I ask you on this daily time frame, all of you will be very clear and certain to me that you can see clearly the impulsive movement. Impulses, retracement, impulses, retracement, impulses, retracement, and impulses. Now, it means clearly here that if I want to look at this, this impulsive, the last impulsive move, everybody can see it because we are on a daily now. Are you seeing any downtrend inside here? I don't think people are seeing any downtrend. On this daily time frame, you don't see any downtrend. All we see is an uptrend. So, but if I decide to take this market now, from here like this to here, and let me carve it out, okay? If we decide to take this portion of the market, let's turn it to blue so that you will have a different color. Let's turn it to blue. Now, inside our blue box is an impulsive movement derived from what? The daily time frame. So, if we switch down to the 4 hours, my friends, you are going to realize that this guy has what? He has a trend in it. And a trend that we can see here can be clearly seen. It can be seen in this manner. Impulsive wave, corrective wave, impulsive wave, corrective wave, impulsive wave, corrective wave, impulsive wave, corrective wave, impulsive wave, a corrective wave, and an impulsive wave. Now, if now we switch this blue, because on the daily time frame we saw just an uptrend, but now we are seeing uptrends and downtrends. So if we come in one of these impulsive waves, especially this one here, let's just take just this wave here. If we take that area here, just this area here, this is just this small area, this small corrective area here, and then we change it to red, for example, that's zone to red, and we go to a smaller time frame like the 1 hour, people are going to see that in the 1 hour time frame, there are what? There is also a wave inside, which is forming an impulsive wave, a corrective wave, an impulsive wave, and a corrective wave. So if we go inside this 1 hour, for example, and select just one wave inside here, let's say we come and select just this part, and put the color again to a different color, just a small part inside there, put the color to, and put the color to, let's say blue or green, and switch it to a smaller time frame and expatiate that zone, you guys are going to see that it forms again a trend inside the trend. So you see, you have now what? An impulsive wave, a corrective wave, an impulsive wave, a corrective wave, an impulsive wave, a corrective wave, impulse, correction, impulses. So you now see that in a trend, there is a trend, is a trend. So my friends, if I decide to select here, one of these impulsive waves here, I select it and go to the 1 minute, I will see the same thing. Here, this is a secret of price confirmation. Listen attentively. This is a secret of price action confirmation. So, this is just a concept to show you that in a wave, there is other wave, and in other waves, but as long as we detail it, we are going to see it. And now I'll use this concept to explain something very, very important to you before I continue. Listen to me very well, very attentively, very, very attentive. So we have a market that is going up. See, it's going up like that. It's going up. It's going up. It's going up. It's going up. Now, it breaks this structure. I stop here. It means it's going up like that. We have our structures here. We have here. We have here. We have here. So now that it has broken our low, we now know that an uptrend is about getting over now. So listen to me attentively. This corrective wave, this other movement that is going to go up, because we must wait for this one for us to sell. Let me give you the secret. Now, on the let's assume this is a 4 hours. So market is going to go up after this break of structure here. After this break of structure here, market definitely is going to pull back. So we are on the 4 hours chart. Listen to me. We are on where? The 4 hours chart. So how can you do to accurately have the exact point to sell this market here? How can you do to have the exact point? You have 2 things to do. I will investigate this wave to see where on this wave we had institutional actions. Where on this wave, where on the previous wave did we have an institutional action? I repeat, where on this wave did we have an institutional action? And maybe on this wave, somewhere around here, we had a drop base. Let's say we had a drop base here. And we saw that there's a point here where the institutions enter. My friends, this structure here now will become a point of interest to you because you have identified it from the previous wave that this is a potential zone where the market can retrace to. Are you getting me? Yeah, listen attentively. Now that you have gotten the point of interest and the market is retracing to that structure, we are done with the first part. The first part was to identify a decision point, DP, decision point, or POI, point of interest, we have identified. Now, we are on the 4 hours. All of this has been done probably on the 4 hours. But now, during the identification of your decision point or PI, you can switch this chart maybe to other smaller time frame to find that structure. Because on the 4 hour itself, maybe you will not see the decision point, or maybe you will not see the point of interest easily. You get it? Now, this retracement that we're having on the 4 hours chart, that is where now you use the methodology that states that in a trend, there are other trends. Listen, this is the secret. I'm telling you, if you do this as I'm telling you on market structures, you will see that you pick precisions. Now, I will not use the 4 hours chart to confirm my entry on the point of interest. I will now take this wave that is going back up. I will switch it to a 1 hour time frame, because I know that in a 1 hour time frame, or in a 15-minute, or in a 30-minute, I'll be able to see these 4 hours candles splitted into a wave that is going up like that. But the person on the 4 hours chart is not seeing it. But you now switch this one now on a smaller time frame, maybe the 1 hour. You will see exactly how this market is going up in this manner. And so when this market now comes up, it is going up, coming up, coming up. Once it approaches your area of interest, which is this area here, you now pay attention to the market structure that is going to create. So what do you do? You now see maybe market react like that. Now come and break a low. You now say, wow, it is clear for me that this market has met the point of interest. Now, there are always fast people that will execute immediately when the market comes to point of interest. Most of them will end up not making a dime. Because what will happen is that after this, when you are viewing now this 4 hours chart on the 1 hour, you are going to see all these structures as I've shown you. Now, you will now pay attention to now confirm that truly that 4 hours point of interest can hold. But now, you only take your confirmation on a smaller time frame, not on the 4 hours. So what does it mean? It means that I will now take this movement on the 4 hours down to a smaller time frame and do my groundwork there to confirm my analysis. So once it touched that area of interest and come down, I know that a low has been broken. And definitely after this low has been broken, price is going to go back where? It's going to have a retracement. So in this retracement now on the 1 hour, I will pay attention to this wave. Let me demarcate it and say wave A, that break what? This low. And on this wave A, I will investigate, my friends, the exact point where institutions enter the market to cause that break. Another person is just looking on the 4 hours. But now you are trading something you saw on the 4 hours, but your groundwork and your confirmation work is being done on a smaller time frame because you can break down the data. And you will see clearly how this market is going to pull back and rapidly touch to the point where the institutions enter the market based on this wave A, and boom, the market now begin to sell well on the 4 hours chart. Sell and go, and go, and go, and go. Some people will say that you know how to trade. It's because you have listened to this that I'm telling you. Same thing. If you were observing this thing on the 1 hour, are you getting me? You will simply switch this market to the 15 minutes and you are going to see a trend inside that 1 hour trend where you will now use to deduce a perfect change in trend. That is what they call top-down analysis, my friends. So that is one great thing. The concept of a trend in another trend can give you to add more accuracy to your trade. Listen to me attentively now. Listen to me what? Attentively. A market that is going up, let's assume, creating higher heights and higher lows, will be forming points. This is a high, this is a high, this is a high, this is a high. So Sometimes, my friends, we are going to be calling this swing high, swing low. A swing is the highest point, highest low, highest height. It means that this higher height here, the lowest point that created this higher height here is this point down here. So this will be the swing low and this will be the swing high, the highest and the lowest point. Now, we have a low here. Where is the highest point that created this low? Is this point up here. So you automatically, this is a swing structure and this is a swing structure. So this is a high up here. Which point created this high? The lowest point that created this high here is this low. So those are how we look at swing structures. Listen. Now, this market moves again down. And as it moves down, it now begins to struggle to go up. And you have something like this. Struggling to go up. Now, the market begins to come down. And then definitely break up. Then put your high here. If I then ask you, where is your low? This is a low. This is a low. But now, the lowest point that created this high is this one right down here. So this point down here will be your swing structure. And this ones here will be the internal structures. So, my friends, you can understand what it means by a swing structure and inner structure. I repeat, a market in an uptrend will form swing and internal structures. The swing structures at the lowest point the market creates and the highest point the market creates. Structure swing, structure swing, structure swing. If this market on its way down creates something like this, like this, like this, and like this, before going back up, it definitely have created some highs, but the highest point that created this lowest point here is this one up here. So this is your swing structure. Until a swing structure is broken, the trend has not changed. Until a swing structure is broken, the trend has not changed. Until a swing structure is broken, a trend has not changed. Until a swing structure is broken, the trend has not changed. So, your ability to identify a swing structure from an internal structure will do you some good work. Now, listen to me very attentively. Strong and weak structure. Strong and weak structure. Strong and weak structures. Now, when a market is going up or down, we are interested in seeing if a structure breaks another structure. Now, this structure here breaks this level. This structure here, A, has broken B. So, A is a strong structure because he has broken. A is a strong structure because he has broken P. Now, this guy comes down. He comes down. He break again. This structure again is a strong structure. I want us to look at strong structure in an uptrend to be the lows and strong structure in a downtrend to be the high. You can look at both, but I want to be more efficient. So, what if this guy come like that, come down, and this guy goes up here? We have this dot here. This structure comes, and this point here is unable to break this high and maybe forms a double top. You need to know that this point C or B down here, this structure, will become a weak structure because it did not have the capacity to break this high. And so this weak structure here can easily be broken off because it did not do what? It did not break a structure. So you need to know between a weak structure and a strong structure. And when a weak structure is broken, it don't necessarily mean that the trend has changed, because this trend is only change when this strong structure has been broken. Because if you want to look at the lowest structure, this is a structural low and this is a structural high because a new high was not formed. Until this guy is broken, that's where we are going to confirm that this trend has finally changed. And so W and M shape, most at time, their take profit target or their validation is mostly done when the other side of the legging is being met based on the structures that you have this way. I don't want to go there for now. I don't want to confuse you, but I want you to remind yourself about the concepts of strong and weak structure. Now, this is about strong and weak structure. The last part of this is, how do I confirm a break? Mostly in a break, I want to see a candlestick settle above or below a break. So when this break occurs, the body of the candle should settle above it, not the wicks. This is a good break because the body of the candle settles above it. And in this other scenario, let's say we have a break here, and it's just the width of the candle that is above the structure. In this scenario, this is not a good break. So with a good break, we want to see a candle settles above the broken zone, my friends. Okay. Let's go to the next. Now that you know about market structure and break of structures, let's do a practical example here, and you will see how it can be done. So let's do a practical example on this chart, starting from demarcating our structure here. where you take the line, you can take a trend line to draw such a line. A trend line is a trend line that I took. I draw and I click shift on my keyboard. Shift will make the line to be straight. Then I have created some templates. To create a template is very simple. So the first time I have drawn this line is your first time you are drawing the line. The next time you don't want to draw the line and write on it. So I've drawn the line. It's a straight line. I'll click on a straight line. This option toolbox will come out. This option toolbox up here will come out. I will click on this option toolbox. See, when I click on the option toolbox, you will see style. The style will be the way you want the line to show. So about the line, forget about the style. Now, text. Do you want a text to be on that line that you have created? Do you want any text there? So you can put it, maybe you want the line to be, the name is a lower height or a higher low. You put HL, abbreviation of higher low. Now, they say text alignment. Where do we want the text to align? In the middle, center, or what? So you want it to align at the bottom. And at the center or at the corners, you take left. So you want it to be like that so that somebody can easily read your work. So left. You can do it for any, when you have done this now, the visibility, make sure that it's visible on the second, minute, hourly, daily, weekly, monthly, and range. Now you come back to text or you just scroll down on that template. You can see the template is always there. Here you see template. You click on the template and you take save as. Save as what? You can just put it HL. Save as HL. You save it. Once you have done that, I already have one HL, so I'll just save my own like this. So they say save. You save and you take OK. It means that the next time I draw such a line for the purpose of a higher low, once I've drawn my straight line, I may not have the time to go and be writing on this line. So I'll just right click on my mouse and I go on that template. I follow template and I just go to the template that I created for that, which is HLL, and I click. So the writing will just appear automatically. So on anything that you do for the first time, you save a template of it. So if you draw a support zone, or if you draw an order block and you want it to be order block OB, the first time you do it, you save the template. So as we are going to be working, you are going to be seeing different things that I'm going to be doing. Along the line, we are going to be saving what? The template. So let's work on a practical example. So this is a low. The highest point that was created before a retracement was this point up here. And I can just left click here and switch this thing to a higher height based on my template. So I switch it to a higher height. Now, I always like to take the tips of the candles. The tips of the candle, the quality should be the tips of the candle when you are drawing this. So pay attention to the tips of the candle. So here, my friends, what you have here was a perfect break because this candle settled above the break. Okay? This candle settled above the break. I doubt if we are going to use just 2 days to finish this program. Because the most important thing is that you push to understand. There is no need to rush. If like it takes us 3 days, by the end of this program, your trading skill must change. Either by thunder or by fire, it must change. So, if now we want to take the lowest point, which is higher height created, this is it. Now, I can just copy this line by clicking on Control on my keyboard. I click Control and hold, then just come and carry the line. That's all. So this is the new structure. Now, you guys can see that this structure struggled to be broken, but it could not break it. It was a fake breakout because no candle settled beneath it. So this is never a break of structure. It's just a weak out. And when doing this market structure, work mostly on the 4 hours chart because it has consistency. Worst come to the worst, you always good to work on where you are looking at market structure to find the direction of the trend and to find true breaks. Use the 4 hours, the 1 day, the 1 week to find true breaks and false breaks. Okay. Now, the highest point, this same thing applies to a downtrend. So there is no need that we are going to do this thing and still do it for a downtrend. So once we have done for an uptrend, is born. That means it's the same thing for a downtrend. So the highest point that this point created before a next possible pullback was this structure here. This tip here. Now, on this tip, the lowest point this tip created, you could come like, okay, this is the lowest point, but this is not it because this was just news. This is noise. In Forex, such abnormality is called noise. So this is noise, and I will not consider it because it's a noise. So this is the lowest point here. Now, the highest point that this point created here on this 4 hours is this, on this wave here is this point. And we had a perfect break of structure there. That forms a higher height. And the lowest point that it formed was this structure here. Now, the highest point that this guy formed, extend this one like that. Now, this is where there will be some interesting work for you to listen very attentive to. Here you have a structure like this. I repeat, you take the wicks of the candle. So once you look at this, the swing highs and the swing lows, this is the lowest point that created this high. So automatically this is a high. This is a new higher height. And so these other structures here are internal structures. They have not broken any high. And even this structure here, we will only know that he is now the new ultimate higher low when this line has been taken off. So as of now, this market remains an uptrend because this higher low has not been broken. And still, we are still to confirm more bullishness once this higher height will be broken. So this market did not break here. This was just a week out. So generally, I will say that GBP USD is still in an uptrend. So that is it about market structures and how you can draw your market structures. you need to pay attention to a lot of work to do. Now, let's move. Downtrend form with lower height and lower low. Market is always said to be bullish. Note, a downtrend fails when price forms a new structural higher height. Wait for a new structural higher low to confirm the trend change. So we have already done, so we have treated this first part talking about trends. Now, we go down. The next part of this lesson is talking about support and then resistance. Support, when there are two or more price points at the low or floor, it forms a support zone which price can react to. Resistance, when there are two or more price points at a high or ceiling, it forms resistance zone which price can also react to. Now, go back to your chart. Now, we are not talking about market structure. We'll be talking about support resistance now. So, this is a ceiling. This is a ceiling. Like, this market here has had like already two price point reaction. This is one that I've drawn. You can see touch one, touch two. You guys can see it very well here. Even one touch can still be considered a support or resistance. So if I extend this ceiling in the future, you see clearly how price have been reacting exactly inside that ceiling. You see it for yourself. So this sort we call a resistance because price has reacted exactly inside the ceiling. You can create a template for your resistance, like what I've just did here. You can select the color. Most of the color I use is somehow a little slight black. Then setting button, you put text to be resistant. And visibility should be everywhere. Visibility everywhere. Go back to text, come on template, save as resistance. So next time we don't need to write again inside the box. We'll just go to template. So this is a resistance line. Now, it means here that this point here, yes, it's a historical high, a key high zone. So here is a support, it's a floor. And this market has a potential that if it comes here, it can react onto it. So support resistance are like ceilings where price have potentials to react to them. And you can see this other one behind here. This was a support and price reacted to the support here. In the future, you can see it. This is the first point where the support was created, and this is a reaction on the support zone. So if price is above a zone, it is called support. So once price go beneath this support, it becomes like a resistance to price. Are you getting me? So you have to understand all of these things when it comes to support, resistance, and much more. And again, I've seen a very beautiful, oh my God. Chat. Let me show you people something. See here. You people see this market here like that, where I just draw the support, right? If you pay a keen attention, see, you guys are going to realize that there was something went on here. Something went on here. And market here reacted on a level here like that. Then quickly went up. Like the real point where the market actually occur, like this is a support. Like everybody is looking at this support. So this is a support zone, which everybody thinks like the market can buy because of this zone. The first time the market comes to the support, it respects it very well. And people now have the impression that market will come back to that point, maybe and form a double bottom. But that is not even the point whereby these institutions are targeting. It means that what? There is a demand zone. That's why around support resistance, you need to pay attention to that areas. So if you come back here in history, you will see clearly and you will attest with me that there's a demand zone that was created. See, this is a demand zone. It was based on this rally basement here. This basement here. You see, the basement was like candles on a coil. So it was a rest. And immediately after rest, you saw the way some fat candles enter the market, some fat, heavy candles. It means that after this rest, that was on the 4 hours chart, some institutions bought this market from here. And definitely not all of their orders were filled. And they have the potential to come back to it. Now, the first time they came back here, people saw the reaction. Let me carve it out to you. Now, when you are looking at the consolidation zone, you take the wicks, all of the wicks of the candles during the consolidations. So these are the candles inside the consolidation, these dry candles. They are the one that forms the consolidation. They are here 1, 2, 3, 4 of them. So you take their highest wicks and the lowest wick of the basement. So if we take the highest wick and the lowest wick of the basement, it will form us this zone. Oh God. See, you see how market came back the first time inside the box. So no matter what market did, it showed clearly that these banks that they bought the market here, not all of their orders were filled. And what happened? They have no choice than to come back and fill some of these orders. And the market buys. Simple. So if I ask you, why did the market buy here? There is no support or resistance here. There is none. There is no support there. There is no resistance. That is just a proof that I'm proving to you that the market will buy massively, sell massively from where institution trades. And I tell you, I know the footprints. And that's why I'm here to teach you. And all of these things is a step by step. So I cannot just start by teaching you, just going to footprints and teaching you this. I need to lay a foundation which will guide you to the best of your output. So you guys can now testify with me that a rally-based rally is a great trading pattern, same as a drop-based drop will be a great trading pattern. So on this basement, it simply means that the market rested, people rested. And after the resting phase, there was a huge volume that spiked away from there. And the only huge volume must be done by these institutions. It's simple. It must be done by them. Oh, I'll tell you the truth. I wish when I was learning Forex, somebody could have taught me this or would have taught me Forex the way I teach you. I swear to God, my mentor was trading support and resistance. support resistance, line on his chart, support resistance. That's how I blew a lot of money. My first money I lost in Forex was $2,000. Lack of knowledge. I had to suffer for at least 2 years. I was suffering. All my small money I would have, I want to put in Forex and I will lose it. I was suffering. I was suffering. I had to toil, pay for different courses, do research, read books, get up at night, do research to get to the point at which we are today. And the best thing is, I will tell you the truth, you have the best knowledge it required to make money in the Forex exchange market. Only your ambition will kill you, full stop. When you want to exploit from your account more than what you're supposed to be exploited, using huge lot sizes and poor risk management. But I tell you, if you listen to what I am teaching you in this class, if you are listening to me very well, you will make money in trading. Let's continue. Let me show you again. See, this particular zone is a critical, it's a what? It's a critical demand zone. It's not a support. It's not a resistance. That's why I do not define demand and supply as support and resistance. I mean, this is why Ronnie do not define supply and demand and supply as support resistance. That is why I do not define it that way. And again, when you extend this box, you can see clearly for yourself that this same place again had to hold the market again in the future. That's it. So somebody who knew about this type of setup here will not be thinking about a double bottom on this blue line, but will be looking upon price even beneath the blue line. And again, my dear friends, before these guys, before the start of the class today, I show you people where when the execution is really about to occur, they start to make you to buy before time. Same thing I first of all show you in the morning. When we started the class, we saw this, like before we saw a sell to buy candle, there was a period of consolidation, which some people bought before time. And when they then zip you now with this sell to buy candle, you close your buy position. See, you see it, they consolidate first, then they then zip now into the demand structure. Then now they then buy rapidly. And I want to tell you, these people must fill all their entire order before this market go out. If you push this section into a smaller time frame, you will realize that this supply, after this sell to buy candle, they rapidly close the sell order that they place here to push people to sell this market and to hit people's stop loss. They mitigated the area. And that's why maybe price may not come back to this area because they fill all their orders here. And that means, let me show you now. Let me go on smaller time frame and show you what we see now. So this is it. So after they dipped this market here like that, they bought massively with this thick blue candle. Price not just went away from the zone with imbalance. You saw that the next 1 hour that we had here was a red candle. Means after price left the demand zone, price came back immediately back into the demand zone the next hour. And the purpose of price coming back into that demand zone was to now fill the remaining orders. And when the remaining orders were filled, what happened? A bombardment. Boom! It's gone. Stop. That's it all. Because the area has already been mitigated. But if we would have had just one long candle leaving this zone right up here, my brother, go up, can down, this market will come back to the zone to fill the remaining order. So that's why when we're going to be looking at structures, we'll be looking at mitigated structures and unmitigated structures. A mitigated structure is a structure whereby when a structure was created, price came back to it and retested it. But when a structure is not yet mitigated, the structure is still fertile. And this particular action here, I believe there was a news event where all of these things happen. And that's why sometimes you say that news itself is just an amplification of what it is. News is an amplification sometimes of what it is. If this to release a news on inflation, this news on inflation or on interest rate is what has happened the previous month. So what has been happening the previous months have already affected the market. Now they come and tell us that this is what was happening, and it will simply amplify the behavior of what was happening. So most of the time, you realize that most news will work along with technical analytics. When your technical analysis is first of all correct, even though now during news there is this period where people manipulate. The banks, they cook you, 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 they cook you. They cook you. So if you don't know how, first of all, how the market works or how the market moves, and you may not be able to even trade news efficiently. So before somebody will come and say that I'm a news trader, I just read the data here. Let me tell you, when the data is released and the time for you to go and read that data and finish reading the data and come back, the action is done. The time for you to go to this thing and read and come back, the data is gone. And now what people fail to understand is that most news, except something like funk news, there's some news like non-farm payroll today that come along with other news under it at the same time with same different informations. And non-farm payroll could be good for the dollar, and the next news, which is still that same time that occur at the same time, which is interest rate, not favorable for the dollars. So now it becomes confusing to even be thinking now the after news trading based on the parameter given, because at that time specific, more than 2-3 news was released, and now you don't know what to do with it. So at the end of the day, technical analysis will be the one to save you during period where more than 2 high impact news are being released. Check it on Forex Factory. You will testify with me that last non-farm payroll was accompanied by other high impact news, which have different data and confusing now after news traders. And at the end of the day, the only thing that could help after news trader was momentum. And momentum is technical analytics, candlestick price action, observation. That now could help you. So I was just trying to show you people some few structures on your chart and trying to make you understand what a support is and what a resistance is, what a demand is and what a supply is. So we'll move to the next slide. Now, impulses and pullback. Impulse, strong and quick movement in the direction of the trend. Listen to me attentively. Impulse, a strong and quick movement in the direction of the trend. Pullback, weak and slow movement opposite the direction of the trend. Okay. So if we go on this chart, for example, I would like to take the current situation on GBP, and we'll use the most recent actions to show you what's happening. So you can see here clearly when this retracement was occurring on this was a trend, which was a downtrend here. You can see the impulsive move are strong and fast movement in the direction where the market is going to. While the pullback are very difficult moment of movement. So my dear friends, once you see such things, you just know that it's a pullback. So even the behavior of the price action can tell you if it's a pullback or not. So you really take your head, you see a market moving like this, and you are struggling to buy this market. That means that it should whip your back. And now you see the impulse is still in the direction of the movement and it's a strong move. Now, you saw when this action got finished here, there was a very strong impulse from the start and a retracement follow. You see such retracement, and you are saying here that GBP will sell until you have smoke manga. You see again a very good impulsive movement, and you see the retracement. If it's a difficult state, and you say the market will sell again until I say you have smoke manga again. So my dear friends, use your eye. Use your eye very well when it comes to the chart. You can see it on your chart clearly. When it comes to the movement, you can see the impulsive move are very healthy and the pullbacks find difficulties. The impulsive movement are very healthy and pullbacks find difficulties. It goes up, pullback find difficulties, healthy movement. It's very simple. So you should be able to even use your eye, my brothers, and see that this is a pullback and this is an impulsive move using simple price action observation. So any trend will have to have impulses and correction, be it downtrend or uptrend, must have impulses and must have corrections. Now, we are still on the concepts of impulses, correction. That means market pushing forward and pushing backward. And that's where we look at this utility tool, which is called FIP retracement. Before I continue, I want to know how many people are sleeping. How many people are sleeping? Love it. Are you sleeping? Nelly, are you up? If I call your name and you don't type yes, shows that you are sleeping and you are not getting me. Yostan, Yusuf, Vani, Terence, Stanley. If you don't say yes, that means you are sleeping. Peter, Basil, Brandon, Mr. Martin. If you don't say yes, you are sleeping. It means Martin is sleeping. You both should get up. I know it's not easy now. It's not easy. I know it's not easy, but you have to be strong. Okay. Let me take a small minute of break. I don't like taking break during morning classes because the break now, people will just like to take a nap and it's over. They will just sleep and get up in the morning. So if we take a small break, it's just for 5 minutes. So I'm giving you a break from 4:24 to 4:30. So you have a small 5-minute break. So the 5-minute break, get up, stretch your legs, and we'll continue in 5 minutes. Secrétaire, tu dors encore. Qu'est-ce qu'on va voyager la journée? Ben, si on voyage, je vais faire coup demain comment? Ce que je pense faire, mais le problème, c'est que le truc là, là-bas, on m'a dit que ça commence c'est à 9h, c'est à 10h. Mais le problème, c'est que si on parle demain matin, on va arriver à quelle heure? Peut-être qu'on va arriver à l'heure qui peut-être sont trop occupés, les gens qui vont faire déjà la cérémonie. Mais samedi, non. Je dirais que vous voulez qu'on go vendredi soir, samedi matin. Sauf si je peux, sauf si je vais en fait le cours de demain là. Je veux le soir, les autres dérange jusqu'à. Je vais voir si je peux faire le cours le soir. Mais si je fais cours le soir, ça veut dire que dimanche matin, il y a encore. Voilà. Aussi, on dort à l'hôtel là-bas, ici à l'horizon. Mais n'aime pas travailler sans machine, c'est pas qu'à ça. Pas qu'à ça là. C'est le village de Moncam, non? Moncam Pascal. Le pays qui est à la falaise. On va se partir là, euh, hey, Martin, they are not far from Bakasa. Okay. We'll be in Bakasa tomorrow morning. Maybe today evening. So that we can walk back to Sanda. We go clubbing there. And smoke the forest money for this week. Okay. It's like it's already 4:30. 2 minutes remaining. 2 minutes left. 2 minutes left for us to push again. Il faut qu'on change la roue de la voiture. Devant. On peut se penser à tout moment. Or mellow plan. Mhm. Okay, good. Okay, let's continue. Okay, we're still on the concept of looking at support resist. We're talking about uh, trend impulses and corrections. So, in most cases, there's also a technique that people utilize to analyze the market when it comes to the impulsive movements and correction movements. So, this technique, for example, can be used if you have an impulsive move like this. It can be used to calculate the degree of retracement which you are going to have in an impulsive movement. So investigating this wave that is getting corrected is one option. And investigating this wave, it means we want to investigate institutional price action. We want to investigate, we want to find an interesting zone. Another way is that Fibonacci tool can be used to find out a degree of retracement. A Fibonacci tool is just support resistance based on the sense of the market. What do I mean? This market is going up. And if this market is retracing, we expect the market to fall back on certain support zones of different degree and strength along the line. So different strengths are being given to these support levels. We can say strength 100, strength 80, strength 50. And we know that, okay, if this guy retraces to strength 61, it means that it can stop from there and then continue back up. So in most cases, we'll use this method with confluence to other factor. Confluence means joining two factors together or joining two parameters together to be able to make a decision. Okay, so here, for example, I have a market that goes thus from this bottom to this top. If I want to calculate to find out how the retracement, where the retracement can stop using FIB technique, I'll put my FIB at the beginning of the movement and pull it up to the end of the movement and then have the different levels. So Fibonacci tool have different levels, and I'll show you how it works. So let's start by putting a wave on our chart. For example, this is a wave. This is the inertia, and this is the terminal of the wave. So here on the note, who is not seeing the screen? I believe everybody can see the screen. Everybody can see the screen. So just check, maybe you have manipulated a little bit your this thing. So FIB 61.8 is a golden ratio. All we are concerned with when using FIB is whether the market is at premium, discounted, or equilibrium price. Listen to me. We are only interested in using Fibonacci to see if price has gone past the 50% line, which is what? The fair market value, which is 50% equilibrium. Discounted prices are cheaper price below 50, and premium prices are expensive prices above 50%. So it means that if I put Fibonacci here, this is a 2, You go, if you want to get a tool, you go to this toolbar here, number 3 box. You will see that FIB retracement. You click on it. Now, if I put it down here, I left click once, carry my mouse to where the movement occur, and left click again. So you can see that the Fibonacci levels are being jotted from these levels here. You have, because if the retracement is occurring, it will start from the top to the bottom. So where it goes, where it retraces a bit, it meets the level called 0.23, which is called level 23. It goes down, it meets the next level, which is 0.38, which is level, this line is level 38. Then the equilibrium line is this level 0.5, which is referred to as 50. So is an equilibrium line. So when we are using Fibonacci, our interest is to find out how far the retracement has gone. So this here, this line here is a 50% retracement line. So if market has gone past 50%, I am interested. It begins to draw my attention that very soon, there is a possibility that the market will change back and go up. So the golden line where most retracement usually occur is level 61. And when this line has a confluence, that means maybe you had a rally base rally, and you discover that the base is at the 61% Fibonacci point. This will give you more strength to your analysis. And so below 50 is the discounted price. That means they are expensive prices where the market can reverse at any time. And above 40, below the 50% are prices where if you grab a retracement ending, it may not work. So this is a cautionary tool to caution you, to make you to be careful. Let's apply Fibonacci here. We have a movement here, for example, that started here at this black line and went up to this black line. Already on this movement that we have, I have a point of interest, which was a rally-based zone that I can demarcate. So I already have one of my point of interest, but I know that I have the point of interest very well, and market can come back to it, and market has come to it. If I wanted to apply Fibonacci here, I would take the Fibonacci, put at the inertia of the movement, take it to where the movement ended up here. Then I will now demarcate it. So when I demarcate, I will just put a line at, these are the levels you can read: 23, 38, 50, 61.8, 78.6. Now, if I take a line and put at 61, this is it, 61. And you guys can see very well and clearly that market came and bounced on the 61 Fibonacci level. So this gives you an extra advantage and confidence over your trade. So Fibonacci utility is just a way in which you could use in your trading, but you may not use Fibonacci in all situations. And it is not all trade in this world, not all trade opportunities that you will take. So it's not all setup that you are going to trade. You're only going to trade what has enough confirmation for you to make you believe that the trade is good enough for you to risk your money in the trade. So Fibonacci tool utility is a great tool and can be utilized on any time frame on this planet Earth. And it can be utilized anywhere on your chart. You can utilize as long as you have a movement. If I have a movement from this top here to this bottom here, I can use Fibonacci to find out the degree of pullback that I'm going to have. No matter where, I will put at my inertia and I'll pull it down to where it stopped. And my first point of interest is to find out if market has gone past 50%. So market is, this retracement went above 50%, which was already good. And at 60%, 61% is already a point where we begin to look for a sell. We're already at the premium prices. So there is a great possibility that the market can sell from this 61. And you see, not far from the market sells. So Fibonacci can give you a chance to filter out Fibonacci can give you a chance to filter out the type of opportunities that you will be taking in the Forex market. You will use Fibonacci anywhere. And I write here, listen very well on my write-up, I said, we are only interested in using Fib to see if price have gone past the 50% level. If price have gone past the 50%, I'm sorry for the poor internet connection, but we are back. So what I was saying here is this. This market have an impulsive movement, and you could see put Fibonacci here to calculate from this top to this bottom to calculate how far the retracement is going to go. So listen, my friends, I want you to understand that you must only trade in the direction of the trend and utilize the tool in correspondence to a valid sense of trade. What do I mean? If a market is going up like that, using Fibonacci here in much more of buy to find buy opportunities are valid. And using Fibonacci to find sell opportunity in this uptrend is purely stupid, as 80% will fail. So you must only use Fibonacci in the trade sense direction. For example, my friends, if I know very well from my trade setup that this was a point of interest and that this market was to come and bounce here and buy for a long term, let's say the market is going to bounce here and buy up to this level, then why will I be using Fibonacci to calculate retracement from this A to this B, whereas I know quite well that market rather will be moving from this B back to B, from this B back to A. So using Fibonacci, you need to correspond with the sense of your trade. It must actually match the methodology that you are utilizing for your trade. So you cannot just use it at random. You must use it at occasion where you're supposed to use. And it must go along with your trade setup. Now, next slide. This is just about we sell at premium prices. So we will sell at higher prices, and we buy at discounted prices. I would not like to confuse more, but I want you to focus mostly on the sense of which you are using Fibonacci and focus on the premium price with that sense. Now, we've talked about the person writing on my screen is neighbor Michelle. So as you are writing on my screen, after this class, Momomi 10K. So now, my friends, we were talking about a trend where we have impulsive waves and we have retracement waves. Now, I want you to understand that a market always have a cycle, and I want you to pay attention to something here. Now, the wave theory is simply this trend theory where market has to move, forming higher heights and higher lows, or lower lows and lower heights. And I always call them wave, like those movement, those impulsive movement and corrective movement. Sometimes I will call them waves. I want you to listen to me very attentively. When I was trying to illustrate here on the board how an uptrend can go, and when an uptrend is disvalidated, for example, a structure is broken like this, I explained to you that you need to wait for a pullback, and then you have to wait like for this burst. So let's say that this structure was broken here. This wave that broke a structure has a meaning. And this wave that led to a pullback has a meaning. And this wave that continued a new market direction has a meaning. So all of these three we incorporate in a wave theory. In some, I think many of you may have seen wave A, B, this and this, that are from all those things. I want to break it down to you today to make you understand that it is something that you know about already. I've explained to you that if in an uptrend, a structural low is broken, it definitely means that market may stop buying. But we will pay attention to the wave that break the structure. And after the wave that break a structure, there must be a pullback. And the wave that you are trading is a wave that bring about a new characteristic. So when the market break a structure, don't be aggressive to just sell. And now you need to pay attention to a pullback, and you will benefit in this other last wave that will carry you to the direction of the new movement. I want you to understand that first before we go back to the wave theory. If you go back to the wave theory, you understand that tips sees the market as line. So I want you just to see this market as this line that you are seeing here I rather looking at candlestick. I just want you to see this line. So circles have typically 5 moves. And so this circle that we have here, it has 5 moves. So this is move 1. From here to here is move 1, move 2, move 3, move 4, move 5. So we have 5 moves. We have not gotten to liquidity for brother. You're in a haze. This program will take approximately 3 days. We are still on the basics of what we are to do. So no hesitation, my brother. So don't be in a haste, bro. You will learn about liquidity. And after you finish this program, it's only after this program that you should ask me a question. Because there's still a lot. If you look at my notes, we have how many pages? 63 pages. We are still on page 5, and you're asking me about liquidity. I mean, all what we have done today, we are still on page 5. That means we are still on page 5 out of 63 pages. So you can imagine the content that is still left to learn. You can imagine what you still have to learn. So just imagine what you still have to learn. So I'm not in a haste. I'll take my time because I want you to be the best. So we have in this 5 movement, we have 3 impulsive waves and 2 pullbacks, which are correction, right? After one full wave cycle is complete, a new wave cycle can start. And the new wave cycle that I want that can start is what I was trying to explain to you people here. That when this guy is being broken, we'll take into consideration this guy that break the structure, this other pullback, and this other guy. They are the one to form a condition for a new way of market movement. So these guys are quite crucial to market structure when the former structure is disvalidated. So those 3 guys are very important, and they will form the core of your success when you achieve the market structure. So I want you to understand that in a clear. If you go back to our notes, you guys realize this. Inside each wave, you can still see a full market cycle in the lower time frame. So as I've explained to you before, if you take this wave 1 and change the time frame to a smaller time frame, you will see beautiful waves inside it. Okay. Now, make sure every time frame is correlating with each other. Now, listen. For the 4th and the 5th waves towards end of the trend and the ABC correction are equals to the harmonic patterns. So I believe that many of you heard about the harmonics. How many of you have heard about the harmonics? So when the market now, when this structure is being broken, that's where you know about the A, B, C wave. So this is the A wave, and this one is going to be C. So we are expected to make money to use A wave, B wave, and make money from the C wave. Okay? So some of you may have heard about the ABC pattern, and you'll be wondering where this ABC pattern is coming from. So the ABC patterns come from where a structural higher low is broken, where we are expecting an uptrend, and where a structural higher low is broken, and we're expecting a new trend. So this ABC wave will be more utilized to us when we are expecting a new wave. And as I've explained to you, you can, in wave 1 here, for example, you can see that you can have smaller wave inside wave 1. And in each wave that you see, you can have, even in the ABC waves, you can have smaller wave in between them all. And the market is a fractal, so you can see waves within waves on smaller time frames. But I wanted you guys to pay keen attention when it comes to the ABC wave, because the ABC wave components will help you when a trend changes characteristics for you to find a new trading opportunity in the direction of the new movement. Now, start of market structure. So market structure, MS, this is the most important part and the basis for all our trading. So market structure here, we form the basics of our trading. It is important to analyze market structure and look for trade once clear on the structure. So you can never proceed with this smart money concept if you don't understand your market structure. Now, these are some key things to take home. 1, our higher time frame, which is the daily and the weekly, will determine the overall trend of the market. So when I'm doing market structure, I will likely go to the daily or the weekly chart to find the overall market structure. Secondly, H4 and 1 hour will determine the momentum and the intraday trend. So those who are trading the intraday trend, after you have found out the overall trend on the daily, on the weekly time frame or the daily, you can use the 4 hours chart to make good trading decision for that day, grabbing impulses and corrections. Now, 15 minutes, 5 minutes, and 1 minute will determine the momentum. So, listen, H4 and H1 will determine intraday momentum. But now, I'm going to use down maybe on the 15 minute or the 5 minute to enter my trade and to determine in depth the momentum. So I will be trading mostly on the 15 minute time frame, the 5 minute and the 1 minute. Why this 4 hours chart can give me a clear structure. So when I'm looking for a confirmation, I will switch maybe the 1 hour chart to the 15 minute to look now like, okay, let's say, for example, this wave on the 15 minute, on the 1 hour that I had, which is going up, if I switch on the 15 minute, I'm going to have series of such waves, and I can easily grab a clear picture whereby a structure will be broken for me to get now the ABC pattern and execute my trade based on the ABC pattern. Okay, so that is very essential to note. So when it comes to market structure, there is a whole lot that we are going to be treating during the next lecture. And for quality reasons, I will have to stop here and continue from here next time so that we don't miss out important information and very strict data. So it's 5 a.m. and from 2 to 3, 3 to 4, 4 to 5, it's approximately 3 hours of lecture that we have had on this technical analytic method. So my dear friends, I would like to wish you people an excellent Friday. And I will have to update you if we'll have a class tomorrow or not. But definitely on Sunday, we are going to have a class, same time till morning. It may happen that tomorrow I may be finding myself, I may be taking a trip tomorrow. I will see the situation in which if I should take my laptop all along. But if I take my laptop with me, the class will not be efficient. Rather to teach you in a class which is not efficient, I better don't teach. If I take my laptop along, the screen will not be big like this. I will not be comfortably seated. I may not have all the strength to teach you the right way. So I will announce to you people if there will be a class tomorrow or not. If there is no class, then it means that this video is about 3 hours. So for those who have listened to it for the first time, can go back on the Telegram channel and re-listen again to this. I will take this opportunity to call on my humble debtors, those that owe me, to come and sow seed in this church so that Papa can pray for you and you can make it big in Forex. I pray because when you look at a case like that of Dominic, a guy that started from Cameroon and today his account size is more than $200,000 real money, and seeing what Forex has done in his life, I remember the good prayer I actually prayed for him. So I see that if I pray same prayer for too many people here, they will be like him. And now for the prayer to go through, you must settle your debt, what you are owing. And you must be able to sow seed to break certain limitations, like to go beyond the real. I'm telling you people, that's the only way. Sow seed. And also make sure you clear your debt. See you shortly. Yes, follow this program to the end. On Sunday is going to be massive. It means that if we don't have a class on Saturday, then we're going to have a class on Monday so that we can compensate Saturday. So we're going to have a class. If we don't have a class tomorrow, then we'll have a class Sunday and then Monday. I don't like to have classes on trading days again, because I will not lie to people. Those classes I get up in the morning and hold with you on a trading day, it disturbs me, because that 5 o'clock I'm teaching you, it should be the time I'm sleeping, because I woke up earlier to analyze. And now the time I have to rest, I am up teaching you. So that's why I'm trying to eliminate classes on actively trading days like Monday to Thursdays, so that you can also increase my efficiency. I should be teaching you, you are making money, I also should be making money. And I should also allow you time during trading days to do your own analysis and have that time to excel. So that's why I'm focusing classes only on weekend. So if we don't have a class tomorrow, then we will be forced to have a class on Monday. I don't want to carry this smart money concept to next weekend. I want that people should apply it from Monday and see results and see true results. So we have 2 other classes to be able to finish with this course, and we'll use same period of time. And so those my new students of January batch, you are lucky. You are lucky because you are learning technical analysis already in a perfect way, in an advanced way, in such a way that the basics of support resistance, all of those things are being treated here. So you don't need to worry again. The way you are learning technical analysis is so perfect that most of you will be so good. So I wish you guys an excellent day. Bye-bye. Thank you, Martin. Martin, I hope that you meet in the back, sir. So hope you are not lying. Okay, Terence, sorry, pa. Sorry, you called that day like, just try call me. We'll work the team for the time now. Terence, sorry, you call, I was sleeping already. So we'll work on the stuff during the day today before I travel. If I'm to travel, I'll travel by 4. So if you want to get to me from 12 to 3 latest. So if I'm to leave to travel, I will be traveling by 4. So by 4, if you call, maybe I'm already driving, I will not pick. So let's just walk. If you are working with me today, just walk from 12 to 3. Thank you, Terence. Shortly, bye-bye.